Wall Street analysts give this deal a 5% chance of happening. Regulators call it an anti-monopoly nightmare. Yet Netflix just agreed to pay $72 billion to acquire Warner Brothers Studio in streaming assets, instantly swallowing HBO Max, HBO, in a vault of legendary IP. This unexpected move doesn't just reshape the streaming war, it threatens to trigger the biggest regulatory battle the tech sector has seen in years. Why were analysts stunned? The consensus was that smaller streaming apps, like HBO Max, Peacock, and Paramount Plus, would consolidate among themselves. No one expected the category leader, Netflix, to simply use its balance sheet to absorb a major rival. Citi analyst Jason Bazinet admitted this was his lowest probability outcome. The result of this deal? A combined Netflix and Warner Brothers Discovery would instantly control roughly a third of all U.S. streaming activity, creating a level of concentration that is unprecedented. That concentration immediately drew political fire. Senator Elizabeth Warren blasted the deal, calling it an anti-monopoly nightmare, warning it would force Americans into higher subscription prices and fewer choices. She urged the Department of Justice to conduct a fierce review. Netflix, however, is ready for the fight. Co-CEO Ted Sarandos argues the deal is pro-consumer and that regulators shouldn't define the market narrowly. They will argue they still have to compete against a fragmented universe that includes YouTube, gaming, and social media. Why did Netflix pay $72 billion for an asset they already compete with? Because they are on the hunt for global intellectual property. Warner Brothers brings a vault of phenomenal IP that can travel across borders and platforms, including Harry Potter, Game of Thrones, The Sopranos, and Friends. Analyst Laura Martin noted there is only one Warner Brothers, and acquiring it stops any rival from ever achieving global scale. This deal, according to William Blair analysts, instantly creates a streaming powerhouse, cementing Netflix's position for the next 2 decades. Wall Street is cautiously optimistic, balancing that huge strategic upside against significant near-term execution risk. Netflix plans to generate between $2 billion and $3 billion in annual cost savings by year 3. The deal is expected to be accretive to GAAP earnings per share by year 2. However, the uncertainties, execution challenges, political risk, and a lengthy approval process immediately hit the stock, with Netflix shares closing down nearly 3% on the announcement. This acquisition sharpens the divide in the streaming landscape, widening the gulf between the winners and the subscale players. For investors, Needham argues that Netflix only overpaid if viewed over a 1 to 3 year time frame. This asset acquisition is a statement. Netflix is defining itself not for the next quarter, but for the next 2 decades. The only question now is whether the U.S. government will let that definition become reality.